Hello everyone, welcome back to my channel. Today we're exploring the world of Warren Buffett, the legendary investor with a net worth that could make your head spin. In this video, we'll unravel Warren Buffett's investment strategy, explore his remarkable journey, and learn how he made his fortune. Let's start at the beginning. How did Warren Buffett get his start in the world of investing? Warren Buffett's journey into finance kicked off at a tender age. At just 11, he bought his first stock, City Service preferred stock, and even made a nifty 4.6% profit when he sold it. By age 14, he had $1,000 saved up for investing, not your typical teenager's piggy bank. But the real game changer was his introduction to the legendary investor and Professor Benjamin Graham. Buffett's education led him to Benjamin Graham's doorstep, where he learned the art of value investing. Graham, often hailed as the father of value investing, taught Buffett the ropes of security analysis. With Graham's wisdom under his belt, Warren Buffett started making waves in the 1950s. He had honed his skills and started investing in undervalued companies like Geico and Rockwood. He had an uncanny knack for spotting diamonds in the rough. His early successes paved the way for what was to come. In 1956, Warren Buffett took a bold step and launched Buffett Associates LP, a hedge fund that would eventually transform into the colossal conglomerate Berkshire Hathaway. Warren Buffett's investment strategy is anchored in value investing. He scours the market for undervalued companies with a competitive edge, be it a strong brand, high barriers to entry, or a dedicated customer base. But here's the kicker: he buys them at a price that gives him a safety net. Buffett's strategy is all about the long game. Unlike the frenzy of short-term trading, Buffett's strategy is about patience. He holds onto investments for years or even decades, harnessing the magic of compound interest. Now let's talk about how Buffett's strategy has evolved. In the early days, he dabbled in cigar-butt investing, finding companies with a last puff of value. But as his portfolio grew, he shifted towards long-term plays. A significant shift came with Charlie Munger. With Charlie's influence, Buffett started looking for companies with a durable competitive advantage and focused on his circle of competence, avoiding industries he didn't understand. Buffett's success isn't just about strategy, it's also about some key rules he swears by. Rule 1: never lose money. This is considered by many to be Buffett's most important rule and is the foundation of his investment philosophy. He believes that it is more important to protect capital than to try to make a quick profit, and he is willing to pass up on investment opportunities if he is not confident in the company's long-term prospects. By following this rule, he has been able to minimize his losses and maximize his returns over time. He emphasizes this so much that he often says rule number 2 is never forget rule number 1. Rule 2: focus on the long term. Buffett is a long-term investor and believes that it is more important to focus on the future potential of a company rather than its short-term performance. He invests in companies with a durable competitive advantage, strong management, and a history of growth. And he holds onto these investments for the long term, taking advantage of the power of compound interest. He has said that his favorite holding period is forever. Rule 3: know what you're investing in. Buffett believes that it is essential to have a deep understanding of the industries and companies you are investing in. He takes the time to thoroughly research each investment opportunity, looking at factors such as the company's financials, competitive advantage, and management team. By following this rule, he is able to make informed investment decisions and minimize his risk. In Buffett's 2022 shareholder letter released in February 2023, he talked about Berkshire Hathaway's secret sauce. He explained how Berkshire finished buying its current positions in Coca-Cola and American Express in 1994 and 1995 respectively. Each position cost about $1.3 billion at the time and produced a combined $116 million in dividends, a 4.5% dividend yield on the full cost at the time. The dividends from those positions are now worth $1.06 billion, meaning Berkshire receives over 38% of its original investment back in dividends every year. But Buffett wrote, "These dividend gains, though pleasing, are far from spectacular. What have proven more important are the capital gains, as the positions are worth $25 billion and $22 billion respectively. Making the right decision and holding on to it is evidently Berkshire's secret sauce." Or as Buffett put it himself, the lesson for investors: the weeds wither away in significance as the flowers bloom over time. It takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s. That wraps up our exploration into the world of Warren Buffett. If you enjoyed this video, don't forget to hit the like button and subscribe for more financial insights.